So now, ladies and gentlemen, welcome back to the session. I would like to begin the session 3 on the future of international financial architecture. So until now, we've been analyzing the current financial situation. Now we would be predicting the future of the financial environment with our wonderful panelists. So now, before we start, I would like to invite all panelists and the moderator for this session. Would you please come up to the stage? Ladies and gentlemen, please welcome them with a warm round of applause. Yes, so we can expect that they will be sharing numbers information through the session 3. Thank you so much for attending in this session. And I would like to introduce to you the moderator for this session. We'll have Bambang Brodjonegoro, the professor of University of Indonesia. I would like to hand over the microphone to the moderator. Would you please start?
A very good afternoon, everybody. It's really an honor for me to be the chair of the last session of this Global Financial Stability Conference. And certainly, although this is the last session, it's not the least, because we are talking about the future of international financial architecture. When we are talking about the future these days, in my opinion, there are two keywords that frequently being discussed. The first, sustainability. Second, digital transformation. So in this session, we will discuss a little bit more about the second keywords, digital transformation. Why digital transformation? Because digitalization in financial sector has been mainstream in our daily life activities. Fintech, for example, has been a common word for all of us. We can witness the growth on basically the strong innovation in payment system, basically making everybody happy, making everybody easier to do the transaction. And also, we have witnessed the growth of peer-to-peer lending, making sure the credit funding available, for example, for small and medium enterprise. And don't forget, in the formal aspect of financial sector, banking sector, now there are, I think, tremendous growth of digital banking. At least what I can share with you, in Indonesia, more and more banks trying to create their own digital subsidiary. So they have their own version of the conventional banking as well as their digital side. And of course, not only banking trying to create digital banking, even non-banking sector, financial institution trying to create the digital banking on their own. So of course, when digital banking becomes part of the mainstream in financial sector, the next question, what happened with the monetary policy? What happened with financial stability? Because then the use of the so-called digital transaction might take significant proportion when we are talking about monetary policy and central bank operation in general. And then we are now also facing another disruption. Usually we heard about cryptocurrency, Bitcoin. Some of them think this is the future of the currency. Some of them think this is just easy speculation to get more money. But then cryptocurrency becoming more and more absorbed in a lot of activities. For example, if I think everybody here already familiar with metaverse. So some kind of IT developer trying to create the virtual world using metaverse, and any transaction in that metaverse, in that virtual world, using cryptocurrency. So you can buy asset virtually, you can buy any commodities virtually, but more importantly, you have to pay through cryptocurrency. Of course, once cryptocurrency becomes the talk of the town, becomes the interest of many people, regulator, in this case central bank or financial service authority, need to have some kind of regulation. And unfortunately, as we know from the history, usually the regulator sometimes is behind the technological development. So I think in this session, we are trying to discuss more about the international financial architecture. First, of course, we are talking about what kind of future digital asset we like to see, and then what will be the impact to the financial stability, to the effectiveness of monetary policy, and don't forget, of course, the impact to financial inclusion, and certainly, above all that, we need to have very strong digital governance. Because we are talking about financial sector, of course, strong governance has to be at the top. And now we are talking about digital financial sector, then certainly governance become top of the top. So I think we have a good presenters as well as panelists for this session to talk about our future in international financial architecture. So I would like to give the floor first to Dr. Stijn Claessens, Head of Financial Stability Policy at BIS, Bank of International Settlement. And I believe Dr. Claessens has been very familiar with this kind of the trend of digital financial system. And Dr. Claessens will be giving his presentation online. Dr. Claessens, time is yours.
I'm very sorry not to be there. I would have loved to be attending in person, but unfortunately, the travel rules didn't allow me to join you in person. Let me talk about future of the digital assets in the post-pandemic era. It is a current and an important topic for sure, as you already introduced. There's a lot happening, so I be short on my motivation. Digitalization is rapidly changing financial services everywhere around the world. It comes with benefits, but also with risks. And the international architecture should and can adapt to this digitalization. So to set up my argument, I will quickly review money. We all know that, but nevertheless, I will give a short review there. I will talk quite a bit about the effect of digitalization on financial services, and then get into the crypto assets that you already alluded to that have been growing fast, but also seen a big collapse more recently, and put them in the context of other developments, fast payment systems, so we can review cost and benefits of relative developments. CBDC is an important part. It's also an important part for the international architecture, and the use case does include also cross-border use. So we want to discuss that as well. And I want to end up with some thoughts on what the international architecture agenda and issues are. So with that, let me start first with a quick review of money. I think we all know that the forms in which money has taken have varied greatly over the years, and we can go back centuries, of course, if not more than that. And we have had stones, we have had pieces of paper issued by a bank in Amsterdam, we had the US dollar, and we had even during the wars some use of cigarettes as coins. So the form of which it has taken has been varying over the years, and of course now we're in a digital world. But the fundamentals as for money haven't changed that much, and that's a good thing to start off with, because the two basic questions we have asked many times and answered many times, of course, is why do we have money in the first place? I think we can be very brief here. The externalities of the double bond, the fact that barter is an inefficient form of trading is clearly one reason. But the other reason is also information, not having to check the content of your creditor all the time is one reason why we have money. But the more important part, maybe in this context, is if you accept money, should it be provided by as a social or public good or by a private institution? And here we have some externalities as well, in the sense that the cost of committing to future collective actions is very difficult for a competitive private sector institution. And this is exactly why government has been the main provider of money. Of course, this inability to make credible commitment came with instability, and this is why central banks have emerged as an institutional solution to both problems. We can talk for quite a while about this, but in the end, we know what we're talking about. The central bank is the foundation of the monetary payment and the financial system. And that's where the banks, as well as the payment service providers, the PSPs, that have taken on a bigger role, are based on. So in that context, we should think about digitalization. What does it mean to the financial services, having that base in mind? And that digitalization comes in many ways and along many dimensions. And I think it's fairly obvious when we start thinking about it. We can have the digitalization affect the financial services as they're being provided. I would call that the production frontier, in some sense, moving it out, lowering the cost. We can add new services. We have a greater surplus if we have new products for the consumer. We can have lower costs as a consequence of both developments, more access, more inclusion. But importantly, also, we have changing in the market structure. So the entry and exit is going to be varying as a consequence of this digitalization, these technological advances, which will alter the revenue and profit streams and the distribution thereof. What we end up with is an overall market structure that is really changing because the IO, the economies of scale and scope, and the related network externalities are really varying quite a bit as a result of digitalization. And I think that is an important factor when we think of stability, but also when we think of the international architecture. Now, how does it show up? It shows up in many ways. Already mentioned prices, the downward pressure on margins and fees. But as anything, we have to balance cost and benefits here. There's also sometimes more scope for discrimination as we move away from traditional suppliers. And that means that the consumer surplus can go sometimes to the provider rather than to the user. And in terms of not only price, but also quantity, we can see changes there as well. On one hand, we may expect more, but at the same time, we can expect less services and think of it as the smart contracts, the composable contracts that we may have. At some point, they may be tailored in such a way that you only need one or a much reduced set of services rather than buying your pension services and your banking services and your trading services. You may get a package that is tailored to you. So we have to keep that in mind as well. Overall, nevertheless, it's clear what is happening is that the cost and profits are going to be redistributed, not just because we have efficiency gains, lowering costs, but also the market structure is going to shift quite a bit in that respect. And here we really have to think about what is at risk in some sense, because the effects do vary quite a bit by the service that is at stake here. These are McKinsey data as to what the total revenue streams are that banking systems around the world collect. And you can think of it as retail banking, commercial and corporate banking, payments, and wealth and asset management. Now, within those groups, I would argue payments have been at risk for a long time now in terms of the new fintech and big tech developments, followed probably by the retail banking, whereas there's also a risk from the fintechs and possibly even from the big techs coming in the future. So keeping that in mind gives us a sense of where we have to focus on development. And then indeed, if we look at the data, and particularly when we look at the new entrants, we see that those are most prevalent in the payment sector. I would say it relates to the scope for the network externalities, but it's also a function of sometimes the quality of services, which can be greatly improved in many parts of the world. It's less entry in the credit side. It's more difficult. It's more competitive. It's more intensive also on the technology. And it's probably the least on the deposit side, where trust and know-how on the regulatory side is still an important component of this market. Insurance has seen some entry as well. The last is the big question, is the big tech entry. Will we see more of it than we have seen to date? We expected it maybe more because what we have called the DNA, the data analytics, network externalities and activities, are the key features of the big techs. And in that respect, they have a very reinforcing feature. So if they were to enter into this market, they could quickly dominate some segments because they have this transformational power that they could. For the moment, we haven't seen it. There have been worries that they would, particularly on the payment side, but for the time being, we have not seen it. That does not mean that we don't have issues to worry about. And the way we try to summarize it here at the BAS in our work that we have done over the past few years, one way to think of it is that we have, and this is not a trilemma that we discussed earlier, that you discussed earlier today in terms of the traditional monetary policy. It's maybe not even a trilemma, but more a triology. Asking the question how we have to revisit our traditional regulatory framework to take into account that data is going to be the driving feature of a number of developments. The way we sketch it here is that there are kind of three trade-offs. Some of them we know. One is a traditional stability competition trade-off in financial services. That's also affected by data, and how well can you deliver services depends on the availability of data. As I said, big techs have an advantage there. But there's also this integrity question of the consumer does not want to be taken ripped off in some sense. So we would call that a traditional stability efficiency trade-off. There's also the trade-off between privacy and efficiency. That's probably a new one. We don't know the details there as well, but clearly the more you share, the more you may have access to data, but you give up your privacy to some extent. And this is a fundamental human right issue in some sense of how much privacy do you want to give up. And lastly, the more traditional trade-off as to whether the regulator can share and have access to data, in that sense balance privacy with financial stability. It's one way to capture the many trade-offs, but it points out that we have a lot of new policy areas, and this is just only domestic, to think about. How do we regulate the new activities that have been coming online? Can we use the activity-based approach that we try to push, or is that not sufficient? Do we then have to disturb the level playing field to some extent? Because we also have to think about the systemic components of some of these players. Level playing fields for big techs may easily become an unlevel playing field given their size and ability to enter markets. Related to that is competition policy. We don't think of it as much in financial services, but we definitely need to adapt and adopt more platform economics. Other services are going to become quite similar in that sense. Telecommunication have some similarities to how financial services may end up evolving, and we then have to adapt our competition and antitrust policies accordingly. Do we have to think about access constraints? Might we even have to think about breakups if there are monopoly powers in the delivery of financial services? And a more narrow issue that we have known for some time is organizational structure. Holding companies were typically used to separate banking from commerce. Do we need to apply these as well when we think of the fintech and particularly the big techs entering financial services? And last, as I already mentioned, the use of data. It's a tricky area. In order to develop these rules better, we probably have to think a little bit more granular. Privacy is important, but not in all dimensions. So what data can be shared and what can be shared usefully is an area where I think we need to do a lot more. And not only kind of from a legalistic point of view, but definitely from an economics point of view. So a lot is happening in the digitalization space in an, I would almost say, traditional sense. But what is happening as well is a fast development, as was already mentioned, on the crypto assets and the stable coins. and related to that, fast payments. Let me review the crypto part quickly. We've seen a bewildering number of coins come on the market. This is just names that you some of them may be familiar to you, but maybe the next chart is actually the more dramatic way of showing it. The number of cryptocurrencies has skyrocketed over the last 5 years or so, and particularly exponential growth from 2020 or so to very recent. So we have had more than 10,000 trying to compete in this market, and in some sense trying to get to these externalities that I alluded to before, that arise both in the provision of money, but also in the provision of financial services. Now, we may think that this is a good thing, that there are many new cryptocurrencies, but in some sense that is not necessarily a good thing, because the fragmentation, and Yun Shin, who's with you there, has demonstrated that in various ways, arises because there's a rent that needs to go to the provider of the cryptocurrencies, the validators. So as a consequence, a certain cryptocurrency has a limited scale, if it were. That means that network congestions and high fees are, in some sense, features of the system. And that explains why we have new cryptocurrencies emerging, at least until recent, on a very high scale, because every time when the congestion hits, there's scope for another currency to emerge and then try to compete in the remaining space. Now, having said that, that doesn't make for a good financial system, of course, when you have congestion and high fees. And that was one of the weaknesses that has been behind the crypto space for some time now. Now, as is typically the case, it sometimes takes a market shakeup to make clear what the weaknesses are. And we saw that earlier this year in May, when the market started to crash, following various collapses of the Terra and other crypto-based stable coins that were in the end not so stable after all, of course, as these weaknesses I mentioned, combined with leverage and liquidity constraints, came to halt and it became apparent. Where are we now? Well, the crypto market is facing a shakeout, so they will be under pressure for some time. This will search for a nominal anchor, of course, and they will try to piggyback on the central bank, because in the end they know that is where the reliable currency arises from. But I think we also need to think very hard about regulation. So regulation of the crypto space has been very moving, in, at least internationally, not yet very fast. I think there are developments now that suggest that there's going to be some acceleration. But that crypto space has to be regulated, if not just from a consumer perspective point of view, also from an AML and KYC point of view. But in addition to that, we need to think hard about what a good stable coin might be. And if there were to be a good stable coin, that could, in some sense, take care of much of this instability that we have seen in this space for now. So that's important because the system as we have is clearly cannot survive. It's a system that was based on an inflow of new users. This is the new DeFi addresses and the unique addresses in this space. And you can see how Ether, that's a big currency used in the DeFi world, in some sense had a high correlation in terms of price changes with the new entrants. And in that sense, it's almost like a Ponzi scheme. The more new players come into the markets, temporarily they can support the price increases, but not for permanent point of view. So this market has some fundamental weaknesses, and they've come home to them. So what is the answer? The answer is better regulation, as I mentioned, both from the crypto world, consumer protection and the like, new regulation for stable coins. What can they be? What should they be? But there's also a lot to be done still in the traditional space. And that takes me back to fast payment systems that we've analyzed and seen for a while now emerging in many countries. It's an element of a development that's been there for some time. If I go back to the RTGS, the real-time gross settlement systems for wholesale payments, those have been adopted everywhere almost around the world. And these fast payment systems are catching up quickly as well, so that the number is increasing to 60 or so. Um, and if you were to take those systems and look at what they have achieved, one good example is PIX in Brazil. Within a short period of time, and this is here the number of users, the number of transactions using PIX relative to the use of debit card, credit card, and bill payments. And what you see in the green line is that this fast payment system introduced by the Central Bank of Brazil within a short period of time have overtaken all the other user of payments, credit card and debit card, individually speaking. So this is a very big success. In part, it was harmonizing by central banks that by the central bank that achieved it. In part, it was coerced in some sense of having payment providers, including banks, sign up for it. But part of it was also just was a much more efficient and also importantly cheaper system. So this chart on the right compares within Brazil the credit card, debit card, and fixed costs, and you see how much cheaper the credit card, the fixed system is relative to the other two. It's a fraction of 10, almost a factor of 10. And that's actually true in the other countries as well. Typically the debit cards are lower, but still there's a large variation here, and suggesting a big scope for fast payment systems to be introduced and lower the cost in those markets. Let me now continue as another complementary development. It's in some sense also probably a substitute or a complement to fast payment systems. But clearly it's alternative to the currency instability, and that is CBDCs, central bank digital currencies. And again, a lot of activity. This is a chart that is already out of quite a bit, in the sense documents how many banks, central banks around the world are pursuing CBDC projects, either in terms of research or in terms of just investigations. But also some live cases. Here it is about 4. I think the number has increased a little bit further, where we have seen actually issuance of CBDCs in the recent years, even on a pilot basis. And China is, of course, one of those as well. Important to keep in mind, and again, why do we digitalize is always a question, but the digitalization is motivated by very different perspectives when you compare advanced economies, the AEs, from the emerging market and developing economies. Everybody agrees that stability is important, obviously, financial stability. People also agree very much on payments safety and payments efficiency, including cross-border being important. But there are some differences is between financial inclusion and the efficiency of payments. Clearly, the emerging markets put a greater weight on inclusion as being an important driver of retail CBDCs, much more so than advanced economies do, and probably reflecting that payment systems are relatively efficient, although I did point out that some countries still have very high cost, and emerging markets like Brazil are catching up, if not even exceeding the efficiency of payment systems elsewhere. These motivations are important to keep in mind, that we don't think of this as a single answer. There's no single use case for CBDCs. There's quite a bit of difference here. That also will be reflected in how we think of the architecture. And at the BS, we've been analyzing this for quite a while now in our annual economic report over the past few years. How we can think of the CBDC being the most productive for both the user, but also for the system, for the supply side, if it were. And what has emerged is that there's quite a lot of commonality in thinking and actual designs as to how we should design a CBDC. Most of the countries are preferring an account-based system, in the sense that the identity then can be identified very clearly, or it's a prerequisite for owning the CBDCs. So the way it's framed here is an account I am, therefore I own, just like your bank account. If you can identify yourself, you can be the owner of your money there. Whereas the other model, the digital token version, has had less interest. It's more based on I know, therefore I own. You have a key, but that doesn't identify you as a person necessarily. It allows you to own the currency or the coin and trade it, but you don't have to reveal your identity on a daily basis. Yeah. So this is clearly one preference that has emerged. The other preference that has emerged is that the central bank, in its design and its operation, prefers what we call here the hybrid model. A hybrid model in the sense that the central bank is not involved in all the day-to-day operations, but is involved in the final issuance and stability of the currency, the central bank digital currency. So it tries to minimize the degree of operational and invasive technology that the central bank provides, but at the same time benefits from the consumer gains. Specifically, and this is maybe too complicated in the picture to spend much time on it, but nevertheless, in terms of balance sheet, the CBDC is still a liability of the central bank with the user A, B, and C having an identified claim there. But the operations and the communications really happens to the PSPs, to the payment service providers that are separate from the central bank, and they execute. That can be banks, of course, or it can be other payments providers, trying to minimize the degree of involvement of on the technology side, but also on the consumer-facing side more generally. So all these developers, what do they mean in the end for the banks and the future of the monetary system? And then I will come to the international part last. Well, the philosophy is, in some sense, with all of this, since it's designed by the central bank, the policymakers can consider carefully the impact of the CBDC issues on the banking sector. In some sense, the central banks are in charge to some degree of assessing that issue. And here they really assess how much competition they would like to have. There is a trade-off, of course, and most of it is only accessible by doing modeling. But basically, you want the central bank allow the commercial banks to have some competition, but not too much migration. How much migration will depend on the regulatory system, of course. But for the moment, if assuming private and public money are both well regulated, then you could see a lot of migration. And that's why it is what I call here the do no harm principle is generally accepted. You want this design to be such that the private lending continues, the two-tier system as we know it maintains itself. And that also means that competition is not an overarching problem for the banking system itself, nor is monetary policy impact a key issue. That does mean that you probably need to think about whether you enumerate the CBDC and whether you have a limit on the balance in the CBDC. Let me lastly come, as I promised, to the international dimensions of digitalization and CBDC specifically. I think we can expect globalization, although it may have had a temporary halt in the last few years, to continue. And so we have signs in many ways, whether it's migrants, remittances, whether it's tourism, that we're still in an upward trend.
I didn't get that. Could you try again?
In many respects. But we also have issues that we have to worry about. So the chart on the right shows you some indications of what people are worried about if it comes to CBDC issuance. So taxation, avoidance, volatility and exchange rates are two issues that come up quite a lot in terms of concerns when we do a survey of central banks in terms of foreign issuance affecting the domestic countries. Interesting, the use of CBDCs abroad is less of a concern, relatively speaking, which in some sense shows a symmetry that your countries are worried about use of CBDCs of other countries in that jurisdiction, but typically not about the foreign ones. Nevertheless, CBDCs are considered an important element in cross-border use by non-residents because they can facilitate cross-border payments and we lower the cost, which is a big issue for many countries. So that is also then the policy question. How do we link the CBDCs across borders in a productive way? And the annual report this year, we kind of think of it as a canopy of a forest. We have the central banks in 2 different countries, where the private sector, whether it's banks or PSPs, provide their services on that are increasingly digitalized and possibly even tokenized. And that's a question of how we will link these banking and payment systems most effectively and efficiently. And there, the thinking is definitely moving away from what has been the traditional system in which payments are made through an originating bank to a correspondent bank, then following the FX markets, and then going from payer to payee in the reverse order on the other side. That's the top arrangements that we know it, to a much more reduced set of transactions and communications, where the pay and the payee can possibly operate through the CBDCs without having those originating bank and respondent bank corresponding relationships there. It's not there yet, but this is the thinking, and this is what actually being tested and experimented in several ways. I list here 3 models that have been put out as kind of theoretical concepts. I won't have the time to go to the detail, but Model 3 is an interesting one in the sense that it really goes to a multi-CBDC currency system that's completely integrated, whereas the other 2 are more compatible and interlinked systems. The last one is more what I sketched to you before, a truly interlinked system. If we can get there, then we may end up with this, what we can call a vision, a monetary system that is rooted in central bank money, but there's a very good integration across the borders without the risks. It requires a proper design. It requires ID issues. It requires KYC. It requires other rules to apply to the CBDCs. There may have to be limits. There definitely will have to be data sharing between central banks on the use of CBDCs at the retail and aggregate level. But with that in mind, one can hope to get an integrated global monetary system that is the seamless canopy that we sketched in the report. So let me stop here and conclude. So a lot of digital transformation accelerated by COVID-19, major implications for cryptocurrencies, for the world. Crypto assets is a part of that. We can learn from it, but it's probably not the solution. There's more scope in developing fast payment systems and stable coins. And in that context, also CBDC will play a role, importantly for cross-border financial transactions, whether it's retail or wholesale. To do so, we'll need supportive institutions. We're at the early stage of what that exactly means. I've sketched some models, but we don't know which one works best. But what we do know is that the central bank will play a key role in assuring a global and open financial system where interoperability is a clearly public good that can support innovative and productive technologies. Let me stop here. Thank you very much.
Thank you, Dr. Claessens, for enlightening us about the possible future of digital currency, especially when you are talking about central bank digital currency and the idea to settle cross-border payment. And I believe there is a part in your conclusion basically saying that this is a good idea, still needs a lot of work to do, but more importantly, needs the support and the right institution. So now we have the next speaker, Dr. Atish Ghosh, who is historian of the IMF. And I think we understand that international monetary system has passed so many challenges in the past, especially dealing with the global financial crisis. And we know that this kind of digitalization is also disruption to international monetary system. So Dr. Ghosh, please, maybe 20 minutes of your presentation.
Thank you very much for that introduction, and let me start by thanking the Ministry and KDI for inviting me. So this morning, Vice Minister Bang started by referring to a quote from Mark Twain, that history doesn't necessarily repeat itself, but it rhymes. And then we heard in the keynote by Maury Obstfeld, he took us back to the 1980s. Then Ian Coase took us back to the 1970s. And I'm going to take you back to the 1930s before I bring you forward again to talk about the future. So I want to just make three very simple points. The first point is that the global economy is undergoing massive changes. We have the scars from the global financial crisis and COVID pandemic crisis. We have some short-term challenges and changes, supply chain disruptions, the resurgence of inflation, which we haven't seen in 30, 40 years. We have some positive developments, but also changes. Stijn Claessens was just talking about blockchain, digital monies, and technologies. We have political and geopolitical fragmentation. And perhaps the biggest of all, we are all going to be facing the consequences of climate change. All these changes are going to have implications for the locus of production and consumption, and therefore on countries' balance of payments as reflected in capital flows and exchange rates. Now, what does history tell us about the resilience of the international monetary system in the face of such changes? And second, what can we do to make the system more resilient? So the central thesis of my talk today is that the international monetary system, either by design or by evolution, begins to fit a particular global economic configuration, a particular global economic structure, and then it becomes brittle, and it cannot easily accommodate major shifts in the global economy. And I will illustrate that by reference to three major crises. One was the collapse of the interwar gold exchange standard. The second was the breakdown of Bretton Woods. And the third was the global financial crisis. Now, what's remarkable about these three episodes is that despite the very long passage of time between them, 75 years, and if you think of how much the world changed in those 75 years, it's absolutely staggering. But despite that, I will argue that each one of these represents a failure of the international monetary system to meet one of more of its core challenges. What are those challenges? Well, these are well known and I think have been repeated many times in different contexts. But challenge number one is helping prevent crises and facilitating adjustment by deficit countries without, in the parlance of the IMF articles, without measures destructive to national or international prosperity. The second challenge is ensuring an equitable burden of adjustment between deficit and surplus countries, and I would add to that a shared responsibility for managing gross capital flows between source and capital recipient countries. And the third challenge is regulating the supply of global liquidity, and in particular, ensuring that there is sufficient global liquidity during times of stress. So the basic implication I'm going to take away from all this is that first, we are going to have shifts in the world economy. Second, the system has a difficulty accommodating major shifts. The changes that are going to happen, we know they will happen, but we cannot predict exactly what will happen and what their impact will be. And therefore, the conclusion should be that future-proofing the international monetary system, making it resilient against changes, should focus on helping the system meet these three core challenges. And at the end, I will talk a little bit about what the IMF is doing in order to facilitate the system in meeting these challenges. So I'm going to very quickly go through three historical episodes, and then I'll talk about how to make the system more resilient. So the first one is the collapse of the interwar gold exchange standard. And the big shift that happens is between the world of the classical gold standard before World War I and the world in the interwar period. So before World War I, the main creditors are Britain, France, Germany, and the largest debtor was the United States. And importantly, the creditor countries, particularly Britain, were willing to import from the debtors to which it had been lending. And in the case of Britain, it was foodstuffs and raw materials, and then they would export finished goods, for example, rolling stock, railways, etc., and they provided the credit for the purchase of those. Governments and central banks were less concerned about unemployment, and wages were flexible. And war obligations were paid for through exports. So the Napoleonic Wars and the 1870 Franco-German War, the creditors were willing to accept the imports as payment by the debtors. Capital flows were typically long-term. Short-term flows were stabilizing, and they were typically for seasonal bounce of payments fluctuations. The gold exchange standard period is actually very different, although I think that was not appreciated sufficiently when it was set up. So the main creditor is now the United States. The main debtors are Germany, Austria, Eastern Europe, the United Kingdom, or Britain. The surplus countries that emerge in the interwar period, France and the US, sterilize the reserve inflows. Central banks become much more, and governments become much more sensitive to unemployment. Wages and prices are less flexible. Investors want fixed income assets, not dividends that can be varied with the profits of enterprises. And most importantly, the creditors, or the recipients of the reparations payments, were not willing to accept corresponding imports from the debtors. So what happened, I'll try to go quicker. So we have World War I. After the cessation of hostilities, the major powers tried to re-establish what was called the liberal international order, the order that prevailed before World War I. There was the Genoa Conference of 1922, which tries to sort of re-establish that liberal international order. We have a period of hyperinflation and so forth, particularly in Germany, Austria, but by around 1924, 1925, Germany, Britain, France, and most of the major economies are back on the gold standard. So this chart, this bar chart here is just the number of countries that are back on gold after World War I. However, the main problem is that the surplus countries do not play by the rules of the game. So after World War I, the US becomes a major trade surplus country, and France begins to become a trade surplus country after it had gone back to gold at a much depreciated exchange rate. Both France and the US sterilized their accumulation of gold reserves, thereby vitiating the external adjustment process, and that means that the burden of adjustment falls on the deficit countries, which have to adopt very restrictive macro policies, and that imparts a deflationary bias to the world economy. And what happens is that after the stabilization of Germany, capital starts being lent by American banks, often intermediated by the London banks, and there's a big capital flows to Germany, Eastern Europe. There are all sorts of anecdotes of bankers coming and trying to push these loans. But the problem is that the adjustment problem has not been solved. It has simply been delayed. So the adjustment problem is that the surplus countries are not willing to import. They keep pushing the adjustment problem onto the deficit countries. That is masked by the fact that there is so much lending going on, more than $1 billion a year in the mid-1920s. But then there's a boom in the New York Stock Exchange, and that draws capital back to the US, and that causes a sudden stop in Europe. And so we have a kind of reflow of capital out of Europe back into the US. And the adjustment by the deficit countries is made more difficult by France insisting on converting its accumulated foreign currencies into gold, the Federal Reserve raising interest rates to prick the stock market bubble. So we have this huge deflationary shock, and basically the liberal international order collapses. Countries leave the gold standard. We have competitive devaluations, exchange and trade restrictions. We have a collapse of international trade, so that spiral is a famous Kindleberger spiral of collapsing international trade. Exports decline, and incomes decline steeply in all of the major economies. And we end up with the Great Depression. Writing before the Great Depression started, Gustav Cassel basically argues that this is exactly what's going to happen because we are not getting the kind of adjustment that is required. It could have been avoided if the surplus countries had played by the rules of the game. They'd allowed their real exchange rate to appreciate. They'd not sterilized the inflows. The global stock of reserves could have been increased by revaluing gold. And deficit countries could have devalued, or surplus countries could have lent to them, sort of recycled the surpluses. But they didn't, and we had beggar thy neighbor policies and this Great Depression. Okay, I'm going to speed up. So the breakdown of Bretton Woods, I would argue, is a similar situation where the system is designed for a particular global configuration, but eventually that global configuration changes and the system cannot accommodate that change. So at the time of Bretton Woods, the US was the clear economic and financial hegemon, and it was expected to be the surplus country, for the foreseeable future. The US undertakes to make the dollar as good as gold, in other words, for official convertibility, and under Bretton Woods, countries would peg to the dollar, or they would peg to gold, but de facto they would peg to the dollar. There were limited capital flows, extensive capital account restrictions, and the system had a flaw, which became apparent later, that it was only the member country that could propose a change in its exchange rate parity. And the IMF's sole power was to either approve or not approve that change in parity. The IMF itself could not force the country to either devalue or revalue. So that's the world that the founders of Bretton Woods are thinking about and designing the system for. But already by the 1960s, the US is beginning to run balance of payments deficits. And in fact, President Kennedy at a press conference declares, we are not going to devalue, which is always a bad sign when the president is denying that he's going to devalue. Capital flows begin to become much more important because of the euro-dollar market and the dismantling of capital controls. And eventually we end up with huge private capital flows that can do speculative attacks in anticipation of devaluation. Okay, I'm going to skip over most of this. We know how this ends or why this ends. Essentially, The US begins to run balance of payments deficits. The US cannot devalue because it's the linchpin of the whole system. It's going to bring down the whole system if it devalues. But nor can it force the surplus countries to revalue. And they're reluctant to do so because they're worrying about their competitiveness vis-a-vis each other. The deficits because of the Vietnam War, the Great Society programs worsen the situation. There are some stopgap measures. The US imposes some capital controls on outflows. Germany, Switzerland start imposing inflow controls. The problem is that the US has been running balance of payments deficits. Its gold holdings are decreasing, whereas its liabilities are increasing, and eventually people are going to lose confidence in the dollar. 1971, Nixon takes the US off gold convertibility, actually as a way to pressure the surplus countries to revalue. He succeeds in that in the Smithsonian Agreement, so the dollar is de facto devalued and European and Japanese currencies are revalued. But it turns out to be too little too much, too little too late, and by 1974, the world is on floating exchange rates. Okay, the third example, global financial crisis. I'm not going to go through in any detail, but the point is, it's again this shifting world. So on the left, I have the GDP in percent of world GDP of either the G7 or the G10, the traditional major industrialized countries. And what you see is that, in fact, I could have extended back this chart. From the 60s onwards, they're accounting for about 65 to 70% of world GDP until 2000, 2001, when there's an almost precipitous decline in the share of GDP of the industrialized, major industrialized economies. And the counterpart is the rising importance of emerging markets, where they not only gain GDP, but manufacturing production and exports shifts to the emerging markets. And that has various implications, and three in particular. Essentially, as emerging market workers who have a high savings propensity, emerging markets go from being a user of international capital to a source of international capital. Global savings goes up in large part because of the savings of the emerging market economies, and that puts downward pressure on global real interest rates. Lower labor costs and higher productivity in the emerging markets means lower price of global manufacturers, and that leads to lower inflation in the advanced economies. The lower real interest rates and lower inflation translates to lower nominal interest rates, and then that goes across the yield curve. So on the bottom right, you see the US mortgage interest rates are very low, and that leads to a search for yield. At the same time, the Stoper-Samuelson theorem tells us that as emerging markets are trading more, real wages in the advanced economies, the labor-scarce economies, are going to stagnate. And on the right, you have just the change in real wages by different educational groups in the US. All right, so let me just skip over. We end up with this sort of triple bubble world economy, one where the US is the consumer of last resort, absorbing the exports and savings of emerging markets. The second bubble is that within the US, the only way that the workers can consume is by getting credit, and they get the credit based on housing prices or lending against housing. Actually, and within the euro area, we have actually the same kind of mechanism in place where the surplus countries are exporting and lending to the periphery, the deficit countries. And all that, these three bubbles kind of burst simultaneously, and we end up with the Great Recession. Okay, so the three examples show us that the system has great difficulty in adjusting to major shifts in the global economy, whether that's the shift in the interwar period, the Bretton Woods period, or the global financial crisis period. So what can we do? Well, we can try and make the system better at meeting its core challenges. Crisis prevention, this is just a chart showing that an emerging market is 3 to 5 times more likely to experience a crisis after an inflow surge, which suggests that we need to manage capital inflows, particularly surges, in an efficient way. What does the IMF do about these things? One is increase our lending toolkit. There were various reforms to make IMF resources more readily available and in larger amounts. We also need to make sure that the fund itself has sufficient resources to play this role of providing conditional liquidity. We have SDR allocations and precautionary and contingent financing arrangements, and the kind of whole global financial safety net, meaning working with other multilaterals and regional financing. And the final challenge, which is actually the most difficult one, is trying to get surplus countries to absorb part of the burden of adjustment. The US has been struggling with this ever since the time of Bretton Woods. At the IMF, we have some surveillance tools, the surveillance decision, the integrated surveillance decision, do exchange rate analysis, and perhaps most importantly is also peer pressure groups within traditionally the G10, the G7, and the G20. I'll just end by talking a little bit about the institutional view on capital flow management, which talks about a shared responsibility between capital source and capital recipient countries, though in fact there's very little of substance in terms of obligations on capital source countries. So to conclude, change is coming, but we don't know what it is or its precise impact. Experience shows us that the international monetary system has difficulty adapting to major shifts, and that is very clear in these past crises. And therefore, if we want to make the system more resilient, we need to focus on helping the international monetary system meet its three core challenges, the whole international community, of which the IMF is part, but the G20 is also an extremely important part, as are other financial institutions. Thank you.
Thank you, Dr. Ghosh, for sharing with us about international monetary system resiliency over time. And I think similar to Dr. Claessens, one of the conclusions is the need to strengthen institution mechanism in order to deal with potential economic challenge in the future. So now we move to our two panelists. The first panelist is Dr. Yun Sungwan, Head of E-Finance Division of Bank of Korea, and I think he will give his discussion about the previous two speakers. Dr. Yun?
Okay, thank you very much. The first speaker, Dr. Claessens, actually addressed the general, various issues around stablecoins, digital assets, and CBDCs. So rather, I'm going to focusing on regulations surrounding digital assets and CBDCs, in particular in Korea cases. So this is my thoughts, and then I'm going to add up my opinions in the end. Okay, in the shaping of the future digital assets, regulations are just as important as investors' appetite for risk and developers' endeavors. Although some digital asset maximalists claim that digital assets will open a new chapter for the economy, but inherent risk to investors and implications in terms of the capital flow management are concerning and may be consequential if unchecked. By reviewing some of the measures that Korean regulators have taken so far regarding digital assets, I hope we could get a better understanding as to why such measures have been needed and about what kinds of future policies might be appropriate. The first regulations that Korean government are taking is banning digital asset-related cross-border payment transactions. So this is long. But regulators at the time, I think I recall this 2017 around. At the time, the regulators were concerned that capital could flow out of Korea to purchase the digital assets overseas. This uneasiness with the capital outflows was intensified by the question at the time, actually, as to whether digital assets have any intrinsic values. As a way of enforcing such regulations, rather than revising the laws, regulators took the approach of not proactively trying to interpret the law in favor of digital asset investors. Digital investors at the time claimed that digital assets could be considered a commodity, and thus any related money transfer should be permitted. As was the case in a couple of years, and as still now, to buy Bitcoin in Korea, outside of Korea, the buyer has to get approval from domestic bank for related money transfer. However, because of a lack of a clear guidance from regulators, the banks are very reluctant to do such a money transfer. Due to such a regulatory stance and as a consequence of it, although there was a strong demand for Bitcoin from the fourth quarter 2017 to the first quarter 2018, so not enough Bitcoin was supplied to satiate local demand. Because of this, Bitcoin had traded at higher prices on domestic Korean exchanges. Second regulation was that banning initial coin offerings. In 2017, Korean regulators implemented a broad ban on any type of initial coin offerings in Korea. So regulators at the time felt that ICOs were mainly motivated by nothing more than simply raise money. So most ICO prospectuses did not provide any clear business purpose or any information about how the raised money would be used. In response to regulations, Korean companies, wanted to conduct ICO and went abroad, to Singapore and Switzerland. For example, this is example. Okay. However, some of those coins issued overseas have since come back to Korea and have listed on Korean exchanges. So I think that they know, at the time they know the loopholes. So, but now it's, as the environment is changing, this year the government and the National Assembly have started a discussion on a so-called Digital Assets Foundation Act. The new government is widely expected to adopt lighter regulatory touch, for instance, by possibly, I think, allowing ICOs. So though this new law, many digital assets, including stablecoins, might be able to be issued for the first time in Korea. Regarding stablecoins in particular, as we central bankers have a keen interest in any changes the new law might bring about in terms of regulations. Although the DAFA Act, the Digital Asset Foundation Act, might adopt, I think, a European regulatory approach to digital assets in a MiCA framework for consumer protection and prudential requirements, many concerns still remain because first, unlike the euros, I think the Korean won is not international currency. And second, stablecoins are issued and traded in the public blockchain networks. So I will elaborate on those two concerns. The first concern is that in Korea, capital flow management and supervision have been conducted mostly with the help of domestic banks. Many money transfers abroad could only be done through banks. However, if stablecoins started to function as a medium of a cross-border remittance and a payment service, that could open a new channel for capital flows. In the case of stablecoins, P2P transfers that do not involve intermediaries are possible because the transactions are carried out on a public blockchain networks. For that reason, I believe supervision and enforcement will be very much difficult. As a solution, I think this is my ideas. As a solution for Korea case, we might think of a kind of requirement for the exchanges. For example, an exchange could set up an upper limit on the amount of stable coins could be transferred from exchange's wallet to investor's wallet. Okay. This second concern is how to regulate supervise the public blockchain networks. Because I mentioned before that most of the stable coins, dollar-based stable coins, are carried out on public blockchain networks. So I think that these public blockchain networks in the future might be able to play a kind of a market infrastructure as a formal stock and the bond exchange. But unlike banks and international payment networks, those public blockchain networks are not owned and operated by any particular person or entity. When the networks goes down and those related money transactions cannot go through, there are no person and no entities responsible. So international, I think the rules should be put in place. So this is my final thought and then the kind of opinions regarding stablecoins and the CBDCs. So some claims that stablecoins are to be the future of cross-border payments. Before we argue about the possibility of such a dream coming true or not, we needed to think first about whether stablecoin business model could survive. As we all are well aware, stablecoins regulations are still in the making in Europe and the US. I think it could be argued that stablecoins are being created in just such a regulatory vacuum. So furthermore, I would say though, stablecoins have succeeded so far in terms of number of transactions and amount of outstanding balances. I think one reason for that success, I believe that is their anonymity. This then, I think it is backs the question that when regulations such as travel rules and an array of requirements such as in MiCA are imposed, could a stablecoin still compete with other traditional cross-border payments methods? This is a question. So considering all those issues that I just mentioned, I believe the CBDC-based multilateral platform actually mentioned the first speaker, Dr. Claessens, could be a kind of alternative stablecoins for cross-border payments. The platform will neither threaten a country's monetary sovereignty, and also by governance and design, will they be able to resolve any operational, I think, legal issues that might occur in operation? So fortunately, the G20 countries are working together on this matter. So I hope that this project speed up and it comes to implement this stage as early as possible. Thank you.
Thank you, Dr. Yun, for sharing Korean experience in utilizing digital financial asset. So now we have the second panelist, Dr. Dennis Nauer, President of Global Solution Initiative. I believe with his latest work, he will be discussing a little bit about the governance. Please, Dennis.
Good, I'm very pleased to be in this panel because there is a basic issue underlying everything that has been said here. And the basic issue is, can we provide more efficiently financial services in a decentralized manner without regulation? And I think the answer to this question in every case is always no. If we did not have basic regulation in terms of laws of crime, property, and contract, then the free market system wouldn't work at all, because it would be much cheaper to steal than to buy and sell. And basically the same principle holds here. With regard to cryptocurrencies, there is a misalignment of interests between the cryptocurrency operators and the public interest, because the public wants money that fulfills the functions of money as a unit of account, a medium of exchange, and a store of value. And in order to do that, you need large network externalities. Everybody has to be able to exchange the same money. And now, Stijn Claessens, to my mind, is sort of the master of the understatement. He said, there are 10,000 of these cryptocurrencies around. They clearly are not fulfilling the functions of money. You cannot, the interoperability isn't there, you can't exchange from one to another in a transparent manner, and therefore they fail as money, and therefore they are used primarily for speculative purposes. Now, I would like to point out in this short discussion a different failure, a failure that underlies a lot of digital governance and is particularly relevant to the financial sector, but not restricted to it, which is a basic misalignment of interests between digital service providers and data aggregators on the one hand, and digital users on the other. The system that we have now operates, as our previous speaker has told us, in a regulatory vacuum. And in this vacuum, digital users get apps and other digital services basically for free, and they give up information about themselves also for free. And this information largely without informed consent. And this information is then used to influence them, either economic influence through advertising, or political influence, or social influence. Elections are undermined. And the other thing that happens, of course, is because we have this barter system where we get digital services for free and we give up information about ourselves for free, the market system is being bypassed. It's barter. And it is third-party funded barter, because the people who pay for this are the ones who want to exert influence on the people on the digital users who've given up information about themselves. And this is, there's a basic misalignment of the interests of the influencers and the digital users. And currently, the digital system, is driven largely by the influencers, the economic and political influencers, who are buying the personal data that is given up for free by the digital users. And that threatens the future function of the market system, because at zero prices the market system can't function. That's barter. Leads to a large concentration of information and market power in the hands of the few. In these hands, there is inherently little incentive to protect privacy and security. And the system exploits vulnerabilities of digital users, psychological vulnerability, some vulnerabilities in terms of information, subjects them to manipulation and gives them limited choices. You can leave your network, but if you leave all the networks, then you basically cannot conduct your social and economic affairs anymore. And so this system is inherently leads to problems. And in the financial services sector, it often leads to mis-selling, selling of financial products without providing adequate information, hidden fees for certain services, incomplete or biased advice for finances, capturing of attention and putting people under implicit pressure to make financial decisions. The system is vulnerable to data breaches and social engineering scams like phishing, for the simple reason that the digital service providers have less incentive than the digital users themselves to prevent this sort of thing from happening. And this, of course, infects the rest of the economy as well, because in personal content purchases, like cars, the purchase of cars is often tied to the finance of cars, and because the two are tied together, the financial service providers own the personal information about the people who buy the cars, there are often hidden fees and overpayment. In peer-to-peer lending, that often leads to over-indebtedness, and therefore one needs to think carefully about how this system is to be reformed. And that is going to be my final point. The system can be reformed in a very simple way, and it simply involves giving control to the digital users of the personal information about themselves. So at present, this information that we give up when we sign terms and conditions, which incidentally, the average app requires terms and conditions plus hyperlinks, on average requires somewhere between 2 years and 500 years to read at normal reading speed. So it basically can't be done. So we do not give informed consent, and we need to get control over our data. How can that be done? The answer is in 4 easy steps. First of all, we need to give ourselves unique digital identity. And that can be done very simply by governments insisting that all official data, your name, your social security number, your property, your health insurance number, everything that requires official authentication in order for transactions to take place, actually receive official authentication on the web. That can be done quite simply through the credit card system, and that be the sole source of this official data and be put under the control of the digital users. Secondly, private data, that blogs that you give or selfies that you take, should be completely under your control, and you can either give it away or sell it, or have your representative negotiate with Google and Facebook what the terms should be under which you transfer your rights. But in any case, it should be under your control. Second-party private data, which is data that is inferred about you, like your psychological profile on Facebook, that needs to be governed by the same laws as govern doctor-patient relationships. So done entirely in the interests of the digital users. Thirdly, collective data, where people come together in a collective to share data. That needs to be done in a data commons space where the people who organize that data have a fiduciary duty to use that data only for the purposes in which this data is given and for the people among whom it is decided to be shared. And once you have these 3 elements in place, on official data, that is under your control, private data that is under your control individually, and collective data that is under the control of the collectives, then you can start talking about rights of association, as you have in labor markets. You can make competition law in the online world analogous to competition in the offline world. You can have legal protection for vulnerable digital users, and you can have GAAP type oversight over data traffickers. And that would put you into a different world, in a world in which users drive the digital system and digital financial system rather than the digital service providers and the data aggregators. Thank you very much.
Thank you very much, Dr. Snower, for sharing about digital governance. And I believe it's already more than 5 p.m. So we have to end this session. Thank you very much for all speakers, Dr. Claessens, Dr. Ghosh, Dr. Yun, and Dr. Snower. And I hope that this session will enlighten us about the future of international financial architecture in a good and promising way. So I like to give back the session back to the MC. Again, thank you very much.
Thank you very much, the moderator, and for all the panelists.